Hi everyone, welcome back. Today I want to go over our graphing problem. This is going to be a review and some help and understanding on how to understand, interact with, and graph exchange rates. And this is helping us understand our chapter on exchange rates and capital flows. And this can be kind of challenging. It's really closely tied to a couple of different things. One of them being international trade, right? Exchange rates are connected to capital flows and international trade. The idea that while we're exporting and importing goods from different countries, if I am selling something I produce here in this country to someone in another country, they have to buy my currency before they can buy it for me. So we're exchanging goods with capital, with cash, with money, with currency of some kind. And factored into that exchange is going to be not just the price of the good, but also the exchange rate, the currency. So I've got a couple of weird currency symbols up here. We've got the US dollar, that's the Turkish lira, the euro, British pound, the Japanese yuan. That's the Thai baht. I believe that's South Korean won. That's the Indian rupee. I'm not a Canadian dollar. I forgot what that one was. Sorry. But there's a lot of different currencies. And so most countries have their own currency. And if we're going to engage in exchange and trade with each other, we're going to have to trade currencies to do that. We also exchange currency to invest in just the value of the country, to invest in that country's businesses. And so exchange rates become really important for just that international component. But also it becomes important for an understanding of how our policies, our domestic policies with respect to inflation and interest rates affect the desirability of our goods and services abroad, our debt abroad, and other factors. And so it's really about how our macroeconomic health is interconnected with the global economy. It can be kind of tricky though, because we're going to be talking about buying currency in another currency. So I think it's really helpful to go through and just review this graph problem together. So I've got my version of it right here. And what I'm going to go ahead and do is I'm going to go ahead and complete this on the doc cam with you. So you won't see me, but you'll see me making notes and graphing it here. And that will hopefully give you a sense of it. It's a nice way to practice and talk about how different factors are going to affect the demand for a currency and the supply of a currency. And we're always going to be talking about two currencies at once. So the demand for pesos in US dollars, the demand for won in pound sterling. This one I just did the market for yen in euros. So if I'm in the UK, or sorry, not the UK, but if I'm in Europe, if I'm in Italy or Spain and I want to buy something in Japan, I might need to buy Japanese yen for that. And so the exchange rate is going to tell me how many euro I need to have to buy 1 yen. That's the exchange rate. And then this is going to tell me how much of that exchange is taking place in the global economy, how much demand for this currency there is. And there's going to be a supply of that currency based on economic factors and a demand for that currency. And all of this is covered in the textbook chapter, in the lecture, and the PowerPoint slides. But we just want to think about the factors that affect the appreciation, the strengthening, the increasing value of a currency, and the factors that affect the depreciation, the decreasing in value of a currency relative to another one. And this has implications for international trade, foreign direct investment, foreign portfolio investment, tourism, fiscal and monetary policy for sure, lots of implications. So this is something that I think is pretty meaningful and interesting to understand. Even though it's complicated, I think it's worth it to get over the hump. If you were comfortable with understanding financial markets before, this is going to kind of build on that. So if you are having trouble, it might be worthwhile to go back and review your notes on either capital flows or just financial markets themselves to get a little bit more comfortable with this stuff. So without further ado, I'm going to switch my camera off, switch the doc cam on, and let's get started. All right, everyone, I'm having some issues with my doc cam, so I'm just going to go ahead and graph this up here on the board. So we want to start out with the market for US currency. And US dollars are going to be the thing that's being bought and sold. So the price of them is going to be in another currency. This is where we get stuck. So I'm going to go really slowly and just setting this problem up. So the idea here is that we have a market. So again, we're going to have a y-axis and an x-axis. And our x-axis is always our quantity of whatever we're speaking about. And our y-axis is always the cost of that. So for this one, our x-axis is going to be the quantity of US dollars being bought and sold on the market, because this is the market for US dollars. And so the price is going to be, in this example, we're looking at Thai baht per dollar. So Thai baht are the currency of Thailand. I think they've got a cute sign, so that's why we're using it, just trying to be kind of interesting. So that's going to be this B with a line per USD. That's the price. So how many baht do I need to spend to get a single dollar is the idea. And then we want to graph this in equilibrium, and I'm not giving you a lot of details, and this is how we're going to generally graph things in this class, is we're not going to be super precise. We're just going to give ourselves some kind of downward sloping demand curve, and that's the demand for US dollars. That's going to be people traveling to the US who need US dollars to make purchases, people buying US goods and services, maybe importing US goods and services are going to need US dollars to make that. Also, people who want to buy US dollars because they think they're going to go up in value. Maybe you want to make an investment in a United States business, you're going to need US dollars. So that's going to be the demand for US dollars. And then we're going to have here the supply upward sloping for US dollars. And the supply for US dollars is going to come from a couple of different places. But if we think about what it said in the textbook, we're going to see the supply of US dollars come from a couple of different places. We're going to see the supply come from the central bank of the country. We're going to see that it's going to be people selling US dollars, either because they've bought them in the past and they don't want them anymore. We also know that one of the things we'll talk about when we get into exchange, or we've seen when we talk about exchange rate regimes, is that other central banks will buy and sell currency from other countries as a way to manage an exchange rate if they have a peg, a floating peg, or something like that. And so we're going to see those entities that have US dollars make up the supply of US dollars. And then we're going to have an equilibrium exchange rate. And that's going to be how many baht you need to buy one US dollar. And given by the problem, I said that the equilibrium exchange rate is going to be 36 Thai baht per dollar. So that means that right here, if I want to buy a US dollar in the current market, I'm going to need 36 baht per dollar. And there's some equilibrium quantity of US dollars. There's not really a figure down there. We're just gonna, I can just put a Q star for these purposes. I didn't give you guys a number. You can make a number up if you want. And if you're not super duper comfortable with this graph, like I said, you can always go back to the textbook, the slides, or the lecture, and they're going to have those same examples. The example that's used a lot in the slides in the textbook is they look at US dollars being traded for pesos in Mexico, and then pesos being purchased with US dollars in the US. And that's a nice, simple example because Mexico's our neighbors to the south, and that helps us really think about, you know, how that, how the exchange, all the exchange that we do with each other works out. So that's just that first step of just graphing that market. So now we have the market for US dollars in equilibrium, where the price is measured in Thai baht per dollar, and the exchange rate is 36 baht per dollar. That's kind of a little messy. Let me see if I've got a skinnier black pen that can make that a little bit clearer for you all. There we go. That's better. Ooh, well, that's worse. Okay, taking way too long on this. Baht per dollar. Okay, cool. So that's our step one. That's part A. Part B says, who is interested in buying US dollars and who is interested in selling US dollars? And we kind of already talked about this, right? We talked about these ideas of who is demanding and who is supplying this currency, but we want to think about it in a little bit more detail. So for Part B, we could say that the people who demand USD are going to be people who are traveling to the United States, right? We're going to see tourists. We're going to be people buying US exports, right? You're going to need US dollars to do that. We're also going to see firms involved in that kind of trade. And then also international investors. I'm just going to abbreviate international investors who are trying to invest in U.S. firms, either directly through foreign direct investment or through portfolio investment. And this is also that chapter where we talked about that, the idea that foreign direct investment is purchasing a portion of a company and having some sort of role in it, whereas portfolio investment is just throwing money into it and not playing a role in it. So kind of like buying stock or something like that. And then the last thing is going to be international investors making financial investments that don't involve actual ownership. So that more like portfolio investment. And so those are going to be the main entities that are going to be participating in this market, both in buying and selling, whether we are seeing people traveling to the US, buying US dollars, maybe traveling away from the US, selling US dollars, right? If you were to travel to Thailand, you'd have to sell USD and buy baht, right? So these things are really, it can be both confusing but also clarifying that it's always the other side, right? It's two sides of the same coin, right? So it's also going to be the supply is these same entities, tourists, those purchasing exports and imports, foreign direct investors, and portfolio investors. There are also people who buy and sell currency in the expectation that it will gain and lose value. We can talk about that as a form of what we call arbitrage, where you just kind of buy something in the hopes that you can resell it at a higher value. So that can play a role too. We don't really talk about that in the textbook, but that's there too. So that kind of answers that question. And really what I'm trying to do here is just get into this sense of who makes up the demand and supply and why we see this market for US dollars exist and sort of what the motivating factors behind it are. Then we have Part C. Part C says, suppose US interest rates decline relative to the rest of the world. So I'm going to get another color here for this. We'll go ahead and do purple. And we're going to say that for Part C, we see a decline in U.S. interest rates. Relative to interest rates in other countries. What would likely be the impact on the demand for dollars, the supply for dollars, and the exchange rate for dollars compared to the Thai baht? And whenever we do these kinds of problems, we are going to be looking at a two-country comparison because that's how we do this, right? We need to have someone else we're comparing it to. And so in this case, we've chosen Thailand as our other country. These things are going to be replicated throughout other markets, but we can kind of think about how there's hundreds of markets where it's the US and Thailand and the US and Mexico and the US and Japan and the US and South Korea and the US and the Philippines, that kind of thing. And so they'd all have a similar kind of effect, different exchange rates, but similar trends overall. And so if we see the interest rate for the US going down, that's going to imply that we're going to expect the returns on investment to be lower in the US. It's going to be a decreased value of investing in US firms. So that's basically going to mean that investing in the US is less attractive and less lucrative, less profitable. So if you no longer want to invest in the US because interest rates are going down, then what you're going to see is we're going to see people not really want to demand as many US dollars. So we're going to see the demand for US dollars go down, shifting in. And we're also going to see the supply increase, because as people are demanding fewer dollars, they're going to be selling them. So a Thai investor is going to say, wow, I bought these dollars to invest in a US company, but the interest rates have gone down. I'm no longer interested in that. So I'd like to sell my US dollars and go demand a different currency. And so we'll see, this is one of the few cases when we see this stuff kind of happen in a multifold kind of dynamic, more than one curve shifting kind of way. And so what we're going to see is that the supply will shift out, the demand will shift in, and we're going to see not necessarily that the quantity of US dollars changes, because that's not really determined by market forces. But what's definitely going to happen is this equilibrium is going to fall. So we have the cost of US dollars in terms of Thai baht has gone down. And you can see that, right? Now the currency is cheaper. So before, if I was coming from Thailand and I wanted to buy $1 worth of US goods, I needed 36 Thai baht. In this case, maybe now it's gone down to I only need, let's say, 26 baht to buy $1. So that's a depreciation of the US currency. It takes less Thai baht to buy $1. So if I wanted to buy a $100 meal in the US on a trip, before it would have cost me 360 Thai baht. Now it only costs me 260. And so again, I'm just picking this number and making it up. The sense is just that we know that when the demand goes down and the supply goes up, the exchange rate is going to, in equilibrium, decrease. We're going to see the dollar depreciate relative to the other currency, relative to the baht. And it's going to make it more affordable to buy US dollars and more expensive to buy Thai baht. And that's the big idea here. So when we see these interest rates go down and the US dollar become less attractive, what we see is that the demand will shift in, supply will shift out, and we'll see that the US dollar depreciates relative to the Thai baht. And we could imagine relative to a lot of other currencies too. And that's really part D. So part C asks you to talk it out. Part D asks you to graph it and use the words appreciation or depreciation. And appreciation is just increasing in value, getting more expensive relative to another currency. Depreciation is getting more affordable. And that's the whole graph here. It's not that big of a problem. I don't think it's too challenging. It's just practicing it and getting a sense of it. And we can think about what this would mean for an economy. We can think about the other factors that could alter it, right? Expectations about future exchange rates, things like how inflation might affect this. But the idea here is that now US dollars are cheaper. What does that mean for these entities? Well, if you're a tourist, it's just gotten cheaper to go to the US. Before, it took 36 of your currency to get 1 of the US currency. Now it only takes 26. So it's going to be more affordable to travel there. It's going to be more affordable to buy their exports. And so that is going to be a positive for the economy. On the other hand, the reason we saw these things happen is because lower interest rates meant lower rates of return for investors. And that's kind of a negative for the economy. We're not going to attract investment dollars. And so with all of these conversations about the effects of interest rates and inflation and exchange rate appreciation and depreciation, these are always going to be pretty nuanced conversations where it's not just, oh, it's good, oh, it's bad. It depends on what your goals are. One of the things we talk about a lot in the macroeconomy in the US is that the US tends to have very strong currency. We tend to have a strong dollar relative to other currencies. And that means that it's affordable for us as people carrying US currency and being paid in US currency to buy stuff abroad, right? Imports are affordable, especially from countries with a weaker currency. But it also means that our exports are really expensive to those countries. So if it takes 20 pesos or 100, let's say it takes 100 Japanese yen to buy $1. Well, that means that a good in Japan might be very cheap to a US consumer, but a good in the US is going to be very expensive to a Japanese consumer. And so there are pros and cons there on both sides. There are governments and central banks that work to keep their currency depreciated to try and push up exports. There are currencies and countries and central banks that try to appreciate their currency because they want to make international trade affordable or because it's a byproduct of attracting a lot of investment. If we think about switching this around and looking at a theoretical opposite situation, what if we had the sense that the US was a very good place to invest, right? If we see investors want to buy US stocks or invest in US businesses, what's that going to do? That's going to increase the demand for USD, US dollars, shifting it out. And as that demand goes up, right, we'll call this maybe part 3, we're going to see the supply shift in, making it harder to find US dollars. And so we might not see a change in the quantity, but we will see an appreciation where now maybe it's 46 Thai baht per dollar. Now it's way more expensive to buy US goods. So an average Thai consumer is not going to want to buy a US made t-shirt because it's so much more expensive than buying one in Thailand. So our exports might fall, but it's because people want to invest in our companies. And so there is sort of this push and pull with currencies and exchange rates and capital flows. And it's really important to kind of get a sense of that push-pull and that there's not sort of a win-win. There's always a cost to everything. So hopefully this helps you make some sense of this, especially as we're moving into some much more dynamic spaces in terms of just like the international news around trade and currency and exchange and all that stuff. It's good to have a sense of the reality that these things are nuanced and complicated, but not too complicated, and that there's pros and cons, right? That there are reasons we want to have a strong currency and benefits to having a weak currency too. And it's really kind of about picking your strategy and being happy with it, in my personal opinion. So that's the basic overview of how to graph market for currency and model some exchange rate behavior. There's more details, of course, in your lecture slides, in the lecture video I posted, in your textbook, the OpenStax textbook online. We did talk briefly about arbitrage. We haven't talked really in this video, but you do talk about in the lecture purchasing power parity, the idea that theoretically, if the exchange rate is all the way up here, 46 baht should buy as much as $1. That doesn't always work out. Purchasing power parity isn't perfect across country lines, but there's a lot of nuance there too. But in general, that's it. Let me know what questions you have, and I will see you next time. Have a great day. And I'll see you next time. Have a great day.